Right.
Once you understand the nature of money, you have deep respect for gold and silver because they have functioned as money for, since the beginning of human civilization. And so the crypto success of cryptos basically creates gold bugs. And the higher Bitcoin, for instance, goes, the more people are out there with paper wealth that might also want to shift some of that money into gold and silver. So that could account for some of the physical offtake on the COMEX and some of the other metals exchanges. It's just the way the global financial system is evolving right now.
For investors and policymakers, the key takeaway is that we are entering an era where real assets, rather than financial instruments, are the primary focus. The capital rotation has already begun. Those who recognize it early will have the advantage. From a technical standpoint, short-term momentum has turned negative for Bitcoin, while it remains positive for gold, suggesting potential for further gains in the coming week, according to analysts at Currency Research Associates, who wrote in a report on Friday. Former Wall Street financial analyst John Rubino notes central banks are aggressively buying gold, with new banking rules boosting its appeal as a reserve asset. Concurrently, a new wave of private investors, many of whom have seen substantial gains in the tech and cryptocurrency sectors, are diversifying their portfolios with precious metals. The world is becoming increasingly unstable, both geopolitically and financially, as well as politically. John Rubino states that investors are turning to physical gold and silver, with many COMEX deliveries driven by fears of coming financial chaos. The COMEX gold futures market has experienced an unprecedented surge in physical gold deliveries throughout 2023 and 2024. According to market analysis, delivery volumes in January 2024 exceeded normal levels by over 300%. This unusual trend represents a fundamental shift in market behavior that could have significant implications for gold prices analysis and investment strategies moving forward. Despite record highs in stocks, Rubino forecasts a return to zero or negative interest rates within 2 years, which would be exceptionally bullish for gold and silver. He warns the U.S. will likely erode its massive debt through inflation, sparking a global currency reset. This reset likely involves a commodity-backed standard, such as gold, thereby removing government's ability to print limitless money. The claim of an imminent currency reset involving gold is not widely accepted as a mainstream economic forecast, though it has been the subject of speculation and discussion in certain circles. Before we dive into John Rubino's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
The world is going a bit crazy out there, on many different levels, geopolitical, financial, political.
Yeah.
And one of the things that you want in times of extreme stress and confusion and chaos is physical money like gold and silver. So it's likely that some or most of the people who are taking delivery on the COMEX are doing it because they want protection from what they see as financial chaos coming their way. So central banks are obviously really aggressive buyers of physical gold and to an extent silver. And regulatory changes in the banking industry have made gold more interesting as a reserve asset for commercial banks. So it could be some of them who are taking delivery now and using that or storing that physical as part of their high quality reserves, and it could just be rich people. There's a lot of paper wealth out there. A lot of it just got generated in tech stocks,
Yeah.
and also a lot of it got generated in cryptos. So it wouldn't surprise me in any way if a lot of the tech money and the crypto money right now is flowing into other things that are more stable. Because yes, you made a lot of money in tech. Tech stocks fell by 90% when the dot-com bubble burst in 2000. We could see a repeat of that again because tech stocks are that overvalued right now by most metrics. So if you've got a ton of NVIDIA stock, you're very rich. Congratulations, nice play. But maybe you want to protect some of that paper wealth by moving into something like physical gold or silver that have held their value for 30 or for 3,000 years and are virtually guaranteed to hold their value going forward. Same thing with cryptos. Crypto guys, in order to really understand cryptos, you have to understand the nature of money.
Right.
Once you understand the nature of money, you have deep respect for gold and silver because they have functioned as money for, since the beginning of human civilization. And so the success of cryptos basically creates gold bugs. And the higher Bitcoin, for instance, goes, the more people are out there with paper wealth that might also want to shift some of that money into gold and silver. So that could account for some of the physical offtake on the COMEX and some of the other metals exchanges. It's just the way the global financial system is evolving right now. Fed, I don't think ever in history has cut interest rates when the stock market was at record kind of bubblicious levels and house prices were at record highs. And the federal government is running a massive crisis level deficit. There should be no reason for the Fed to cut and lots of reasons for the Fed to tighten with the things going on that I just mentioned. So it's not a surprise that they're not cutting. But on the other hand of that ledger, you've got Donald Trump, who's an easy money guy. I mean, he's a real estate developer, and in real estate, lower or zero interest rates are the best thing in the world. And so he's president, but he's still who he is. And he really wants lower interest rates. And I think he'll get them somehow, one way or the other. Either Powell and the rest of the Fed governors will start cutting. You can point to some macro things that make cutting defensible, I guess. We just had some bad labor market numbers, for instance. But it could be that they start cutting because they don't want to hear Trump saying their name every day in press conferences and stuff. And so we get lower interest rates, or they'll leave. Trump will put somebody in their place, put people in their place who are aggressive, easy money economists, and they'll start cutting aggressively just because they believe that's the right thing to do. So I think within 2 years, we'll be back in zero interest rates and maybe negative interest rates. And that's phenomenal for precious metals. I mean, that's an environment that you can't get any better for gold and silver than negative interest rates. Because first of all, that's inflationary. Second of all, it makes the carrying cost of gold less onerous because you don't have to compare it to a 5% treasury bond yield or anything like that. Everything's zero out there. Yeah, I think that's good for precious metals if it happens. I think we are, financially speaking, we're screwed regardless. We borrowed way too much money. There's no fix for what's coming. We basically have to deal with this debt. And there's only two ways to deal with excessive debt. You default it away. In other words, everybody goes bankrupt and that debt ceases to exist, but at the cost of a 1930s style deflationary depression. Or you inflate it away by creating a lot of new currency, which lowers the value of the currency, which makes debt less onerous because you're paying it back in cheaper currency. We're going to try the inflationary side without a doubt. I mean, Trump will do that without even understanding that he's doing it, because he just loves his low interest rates. And so we'll inflate away our debts and suffer the consequences of that kind of a policy choice. We'll have financial chaos, rising inflation, a catastrophe in the bond market, very possibly. And then a monetary reset at the end of it. So I think that's baked into the cake, barring World War III or some other massive black swan. The emergence of sentient AI. Let stuff like that happen, and our little financial discussion stops being relevant. But in the absence of some gigantic civilization-changing event, we got a garden variety financial crisis to get through. The kind of thing that's happened 50 to 100 times in human history, and it always played out the same way. And this one will too, with the only difference being this time it's global, not country specific. It used to be one country would screw up their currency in the context of a sound money world where everybody else was on a gold standard. Now nobody's on a gold standard, and everybody else is screwing up their economies and their financial systems and their currencies. kind of sort of in the same way. So I think that makes it worse. It's
Yeah.
it's allowed us to get by much longer making these financial mistakes, but it leaves us with nowhere to run when it catches up with everybody. So we'll see basically a global currency reset sometime in the next few years, preceded by some kind of a crisis that makes the currency reset the best option on a very bad list of options. Governments don't want to do this because a currency reset would necessarily be a return to some kind of a commodity-based standard, like a gold standard. And I'd say there's less than a 10% possibility of like a Bitcoin standard or something.
Financial analyst John Rubino rejects the feasibility of a debt jubilee, arguing it would destroy assets underpinning the wealth of powerful stakeholders and ultimately precipitate a currency collapse. Increases in the national debt have long been squandered on expanding social welfare programs, ultimately leading to higher debt service, which yields an effective negative return on investment. Therefore, the larger the debt balance, the more economically destructive it is, as it diverts increasing amounts of dollars from productive assets to debt service. Meanwhile, Rubino emphasizes that the precious metals bull market is intensifying, with major M&A activity poised to boost junior miners. Recent billion-dollar royalty deals from Royal Gold and Franco-Nevada signal big players are ready to spend. Historically, such moves trigger sharp gains in smaller exploration stocks, potentially marking the start of a major rally. Gold companies can potentially generate higher total returns than an investment in physical gold. That's because these companies can expand their production and reduce costs. These factors can enable gold mining companies to increase their profits, enabling their stock prices to outperform the price of gold. Let's get back to the interview.
The term for that is a debt jubilee.
Okay.
And basically, that doesn't work. But partially because a lot of the debt out there is somebody else's asset. So it's a liability, but it's also a thing that represents the wealth of some very big, very powerful entities out there. So you wipe out that debt, and you're going to have an insurrection on your hands, and it would be incredibly destabilizing. And if you wipe out, for instance, that whole side of the ledger, the whole debit side of the ledger, but not the currency that's in the world, that's massively inflationary, because then you've just got all this totally unbacked currency sloshing around, and you still got, it might be tried, but it would almost certainly crash the currency. Well, I mean, there's a ton of interesting stuff happening in the precious metal space right now because it's a bull market, and in bull markets, interesting things happen. But one of the things people are waiting for is the big burst of M&A. In other words, mergers and acquisitions in which bigger gold and silver miners buy out the smaller guys and then drive the price of the little miners up. Because, most people who are in this space tend to end up with a portfolio that has a bunch of explorers, these little microcap companies that are 10 baggers if everything goes right. And the M&A pickup is what lights a fire under those stocks in most precious metals bull markets. So when the big guys start buying out the littler guys, there's your signal that those little tiny stocks that you wondered if they were ever going to go anywhere are getting ready to take off. So maybe this is the beginning here, but a signal that may be the case has just started happening in the last few days, and especially two big royalty companies, Royal Gold and Franco-Nevada, just bought really big royalty streams. In other words, they contracted with another mine to help finance that mine's growth or its opening or whatever. And in return for that, they get a cut of the production of the mine. So it's a great business model. The royalty companies are very successful. They generate massive amounts of cash. Their stocks have done really well. But now that you've got the bigger players really stepping up to buy, one of the deals was for $500 million, which is very big in this space. The other deal was for $1 billion.
Wow.
And $1 billion royalty deal is huge. It's a really impressive deal. So we're seeing some big numbers be tossed around. These guys have cash flow to play with, and they're clearly ready to spend it. Expand that situation out to the miners, who are also generating lots of cash flow from having gold go up by $1,000 an ounce in just the last year or so. And they're going to start, well, in theory, they're going to start buying each other out pretty aggressively here, because that's normally the way it happens. Again, there's 50 million gold bugs around the world who've been waiting for this to happen, and it's finally starting to happen. So this is a very big deal in our little community. And if it plays out the way it has in the past, we're about to get a lot richer. That's the key thing.
John Rubino's analysis presents a clear picture of mounting U.S. debt, and the convergence of aggressive central bank gold buying is creating a powerful bullish backdrop for precious metals. Gold prices are projected to rise by approximately 35% in 2025, before moderating slightly in 2026 as some of the prevailing uncertainties begin to dissipate. Overall market sentiment and investor confidence are also factors that can influence the price of gold. If this cycle unfolds as Rubino anticipates, will those invested in physical metals and high-quality mining stocks be among the few prepared for the upcoming global monetary reset? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.